Dallas Fed President Lori Logan there on the central bank's rate hike policy. And our next guest sees a lag in policy transmission when it comes to inflation. And when it catches up to reality, the price pressures that we're seeing will come down faster than ever. Let's discuss all of this with David Kudla, who's a CEO and Chief Investment Strategist at Mainstay Capital Management. David, always great to have you with us. So do I extrapolate from that you think there is still, a bit of runway when it comes to being risk on, maybe a little bit more overweight on tech and some of the same themes that we saw drive the rally of the first half in the second half?
Yeah, I think there's runway left, and I think technology is still the place to be. Growth stocks are still the place to be. Certainly did well in the first half of the year. Today it's going to give everybody some pause to see a day like today with yields spiking the way they did. But if we look at the second half of the year, we still look at a constructive environment for stocks, and especially growth stocks and technology. The Magnificent Seven, as we call them, we wouldn't be trimming those yet. We would stay with those because they're more immune to, take today, Microsoft and Apple were both positive.
So valuations at this point in that space are okay for you still?
The valuations are sky high for stocks like NVIDIA. But when we look at how we trade stocks and what we trade based on, there's concern that there would be an earnings crash, and the earnings for these companies continue to come through. Could we see a correction or a more significant correction, especially in some of these high flyers? We certainly could. But, looking at a long-term secular growth story that many of these stocks have, there's been comparisons to the dot-com era, but it's very different. These are established companies that are going to benefit from this AI technological revolution. And we're also seeing the leadership starting to broaden out. We saw small caps do a little better in June, and we're seeing an overall broadening of the breadth in the market.
And David, what will you be watching out for as banks kick off earnings season next week?
We expect that, it's certainly with the stress test, they were able to do some things with dividends, and that was a positive for banks. We're still concerned about the financial services sector simply because we don't know that we're out of the woods there. The Fed has created a problem for the banks. That's what happened with SVB and a handful of others, and that risk is still there. So I think the earnings for some of the powerhouses like JP Morgan that will continue to do quite well, but the regional banks, we would continue to avoid those for now. There's been some periods where they've spiked off the lows, but there's still a risk because the Fed has created a problem with these high rates that they can't bring their money market rates up to without just suffering losses.
And David, of course, geopolitical tensions now at the forefront with Secretary Yellen in China this week as well. Are there any themes that you would invest into that could benefit from the de-risking, decoupling of these two economies?
Yeah, if we look abroad, if we look at, let's take Japan, China, and broader Asia. In China, tensions are so high. You could arguably, the differences between China and the U.S., the relationship is at a very low point. And internally, there's problems with China in terms of growth and so forth. Take Japan, conversely that, Japan and other Asian countries are benefiting from that somewhat. There are flows out of China. There are capital flows into Japan. The Tokyo Exchange has urged them to implement more dividend payouts and buybacks. So in Japan, and with the diverging monetary policy, their short-term rate's still at 0.1% versus the aggressive rate hikes of the Fed, ECB, and other central banks over the past year or so. Japan's attractive. We think other Asian countries are attractive, but those emerging market countries do need China and China's economy to perform.
Yeah, and you said it. I mean, those capital outflows from China are already pressuring Chinese assets. Can you find any opportunities for bargain hunting in this environment?
I think there will be. But we wouldn't make that big move yet because we still see these concerns. We've had these U.S. officials go over there that are going over there, Yellen right now to talk. work through. But at the same time, we have these sanctions on critical materials. We're limiting what we're sending to China in terms of semiconductors, and they talked about limiting the materials we need to make semiconductors. We're going back to that type of environment instead of working towards a more constructive environment. Even the language used, we talk about a de-risking of our global supply chains because we saw how much so much coming from China affected our industry and the global industry. And what we call de-risking, they're calling China officials are calling decoupling. So there's some real issues to work through on that front, and that spills over into the markets and how people feel about investing in China right now.
David Kudla, always good catching up with you, CEO and Chief Investment Strategist at Mainstay Capital Management.